Would Bayer and Lehman still be out there as independent operations had they maintained their partnerships? And I think yes, because I knew the risk. When they did an underwriting, they were sort of trembling for the few days they were at risk. And what we morphed into is instead of 15% capital and unlimited partnership liabilities, you get down to 3% tangible capital, and the rest is history.
The Swiss National Bank this week, and I believe the working number is 19% of capital. You've suggested, I believe, in the FT, 14% of capital. Were you surprised at how strict the Swiss National Bank seems, how they're leading out of Basel?
Well, I think that you got to remember the Swiss banks are special. They're special in the sense that the combination of the two big banks are in themselves larger than the government.
Right.
And as a consequence, the notion of bailing out one of those banks is a different concept from what we envisage in the West and the United States. It strikes me that the critical question that they confronted, which we were always aware of, in other words, it's nothing new about what has been going on in the last several years. There were all sorts of contingency plans of what if. Mm-hmm. There was, for example, a general expectation that in the event that in the international financial system there was a dollar problem, the Federal Reserve would take the lead on resolving it. And if sterling, London. But the issue was always, what do you do about Switzerland, where there really is no effective backup to those two large institutions? And I think what we're observing today is a recognition of that fact, and in a sense, for those two institutions to exist in the context of the potential now, which we never thought of before, of bailouts, requires that they have an extra layer of capital that others don't need.
Shoots at the moment, the Brazilian finance minister, maybe it's a currency battle. You couldn't talk about the dollar as Federal Reserve Chairman. That was Treasury's department. Tell me about your take on the dollar as a weapon or tool in this financial crisis. Are we using the dollar now in a way that we will regret in the future?
I don't know, but I thought it was really quite fascinating that in the most recent Euro crisis earlier this year, the ultimate safe haven was still the U.S. dollar. And that tells me that as difficult as the problems are, that we would have to do very considerable damage to the dollar as a unit of exchange before we do it in. And that is not to say there's carte blanche, we can do anything we want. But there's the old basic law of supply and demand that if you create more claims against goods in the United States, the value of those claims has eventually to fall. And all of financial history indicates that you can have the money multiplier not function for a while, and you get a sense that you can maintain very large balance sheets in the part of the commercial banking system, or very specifically the Federal Reserve System, without consequences. But everybody, the current people especially at the Fed, are very sensitive to this question, not only of the size of the balance sheet, but how do you ultimately unwind it? Because the time you're unwinding it, it necessarily means you're tightening monetary policy. And that is always an issue that emerges when you start to involve yourself in expanding the balance sheet. And I think there's a lot of discussion. I obviously have no direct insight into what's going on at the board, but the discussions are two-sided in the sense that if you're going to expand, you've got to think of the routine by which you're going to bring it back down, or confront the problem that at the moment, the so-called money multiplier, that is the ratio of either the M2 to the monetary base or total commercial bank assets, or even intermediation in the total system, the monetary base, that does not have a long-term trend. It goes up and goes down and goes up, and it tends to be mean reverting to a greater or lesser extent. And that basically is the same thing as saying that over a long period of time, the level of unit money supply, that is the total amount of money supply, however defined, times the capacity of the economy to produce, tends to match the long-term price levels. But the issue here is that one of the measures of future, the issue of confidence in the future, is the extent to which the business community takes cash flow, which by definition is liquid, and puts it into fixed assets. And what I point out in this op-ed piece this morning is that the share of cash flows, which are rising, because the profitability has been just terrific, as you know, the proportion of cash flow going into fixed assets in the first half of this year was the lowest as far as we have data going back, and they go back to 1952. This tells us that there's an extraordinary aversion to illiquid long-term investment, and it also is a reason why, of course, cash flow has got to go somewhere else, and it's gone mainly into liquid assets. And we've had the sharpest increase in the share of liquid assets on non-financial corporate balance sheets in the United States in history.
By your definition, is it a new bubble? Is it a bond bubble?
No, not in that sense. I mean, a bubble usually has buoyant, positive characteristics. It's usually the other side of risk aversion. Bubbles tend to become corrosive. There's a sense in which, if you said to me, are we getting a selling climax? That's almost a different issue. It depends very critically on what the cause of this problem is. And as I point out in today's op-ed piece, it is clearly fear, because remember that when people become uncertain and fearful, they disengage from what they are doing. And you can see the disengagement by just watching how corporations allocate their cash flows.
If you go back to Night 21, which you've spoken on and written on at great length, the work of Frank Knight, or you look at David Kennedy and his classic piece on the Depression, one of the things that you get from Kennedy, which came somewhat from Frank Knight, is the numbness of the 30s. And that the administration in Washington was surprised how docile the people were. There's almost a numbness now in business.
I'm afraid there's a good deal of analogy here. There's nothing. We have the highest level of liquid assets in basically 50 years. And as most people in this room would tend to be working with, are equity premiums. Equity premiums, as estimated by J.P. Morgan, are at the highest level in 50 years, too. That there's something very different about what is going on, and how long it's going to take to get out of it means when is the anxiety levels going to unwind. They will. Human nature doesn't stay at this level indefinitely.
When you look at a Greenspan prescription to move beyond this, is it a prescription by government? Does the government get out of the way and let the financial system solve it itself? What would you recommend to the administration or to any nation's administration in jumpstarting this?
Well, there seem to be basically, whenever anything goes wrong, government has to fix it. And so we've had monetary policy fixes and fiscal policy fixes. There is a third alternative. It's let the system heal by itself, as it did all through the 19th and very early part of the 20th century. There is evidence that suggests that if you allow a system to simmer down you get the analogy of the stock market selling climax. It is not an accident, in my judgment, that the fact that the one area where we didn't intervene is in stock prices has been able to come back fairly significantly, and indeed through all of the period, really since early March 2009, it's been a really remarkable recovery. I think that we ought to give it a chance, to leave it alone for a while and see what happens. My impression is we will be surprised.
Is austerity something to fear? You've taken a more strident tone here. Do we need the austerity we're seeing in the United Kingdom? Do we need to bring that over to the United States?
Well, the answer is yes, you need it. And the question is, how in the world do you do it when say Social Security is the third rail of American politics, and so is everything else? One anecdote, which I think is really useful in this context, is when Ronald Reagan ran for president in 1980. You may recall he was in favor of a major tax cut, big increase in defense, and he left it to some of his friends to figure out how you make the budget come together. Well, we did. It was a real shoehorned effort, I will tell you. But that laid the groundwork for what the first budget that was put out by the Reagan administration in its original form before the political system got hold of it. And his question to those of us, and basically it was to David Stockman who was doing the job, this is very tough, but you know, we have to do this, and my only question to you is everyone being treated equally harshly? And I said to myself, that is a very thoughtful notion, because people, if they're determined to be, they're confronted with a real serious problem, if they believe everybody is doing the same thing, they go along. I mean, I'm a little bit surprised, for example, that Papandreou in Greece, despite what is an extraordinarily tight program, has still got its popularity. And I think the reason for it is that there is a perception that everything is being handled in a fair way, and they recognize that if everybody, it's a very interesting spirit which is general across all cultures. And I think that Cameron's having a little difficulty at this moment. As you know, there's talk about whether they're going to have to let it slip a little bit because they're having trouble cutting. But I think he's got the right attitude. That is, the issue is fairness. You hit everybody. Because if you start to show any evidence of favored groups, then you cannot bring the society together. But I think as Papandreou is demonstrating, and I think as Reagan demonstrated in part, and in fact, virtually everywhere where they achieve this, because, you know, I was seeing this paper, he's got a very interesting paper in which he demonstrates that the examples of major reversals of fiscal problems, when handled from spending side, tended to work, but when handled from tax side, it didn't.
Right, the IMF agrees with this. This World Economic Forum.
And the reason that I think that that result occurs is that if you raise taxes, you will close the deficit, but you will not change the propensity to spend. And you're just going to have to raise them again and again and again. And it doesn't solve the problem. Now, I think that we're going to have to raise taxes because that, no matter how much we would like it to be otherwise, and I would like it to be otherwise, there's no political scenario of which I'm acutely aware in any sense whatever that that's going to happen. But I think we have to get started on this problem very quickly. So I'm advocating what seems to be a very radical position let the taxes lapse. And one of the aspects of the article I wrote this morning is demonstrating that there's a good deal of crowding out
Right.
of capital investment caused by the fact that the deficits are getting very large. First of all, let me say that, as I said in that June piece, I did not expect the issue to emerge in a crisis form through the end of this year and possibly well into next. And the reason is we still have a fractured financial intermediary system. You cannot have inflation if you don't have the money multiplier operating. And right now, we don't. And the reason we don't is that you've got a situation where we've got a near $1 trillion of excess reserves sitting in the commercial banking system, and they're getting 25 basis points. And yet, if you look at the gross flows of commercial and industrial loans, you can get reasonably short-term loans at 150 basis points over what they're getting from the Fed, and they're pretty safe loans. It's not happening, and the question is, what is the reason why a commercial bank is sitting there with overnight funds of 25 basis points and not lending it out? And the reason is they don't think they're going to get repaid. There's no other explanation except its equivalent, which is they don't have enough capital. But that's actually the same explanation, because obviously, if you have enough capital, you're willing to accept more losses. What I'm trying to get at here is I think we've caught, and this is as close as I know to the issue of Keynes's liquidity trap. Mm-hmm. That is, we're not turning the system, and unless that happens, you don't have the inflationary problems and the rise in inflation premium is embodied in long-term rates. So we do have time in that respect, but for those of you who were in the markets in 1979, it's very difficult to forget that we viewed the rising inflation rate at that point is not a serious issue because the United States, by our nature, were not inflation prone. That psychology broke virtually overnight, and we ran up 400 basis points within, I think, a couple of months. And it really was chaos. So the presumption...
You're suggesting that could happen again?
Well, when it happens, the most likely way it's going to happen is precisely that way. I haven't a clue when it's going to happen, but because I don't have a clue, I ask myself, so far as fiscal policy is concerned, if you don't know the answer to a question like that, you have to ask yourself, what are the consequences if you're right or if you're wrong? Now, if we are wrong on the issue and we take very high risks that we will be able to wait a couple of years or 3 years and then do something, and we are wrong on that, it is really a very dangerous potential outcome. If we take the other position, being too conservative, and we're wrong, that is readily easily fixed. So I think that we've got to start to take action now. We have not cut a single program of importance in a very long time. And we don't have very many places to cut. We're going to have to start to cut in entitlement programs.
Huey, too, I've got a wonderful question from one of our senior economists and strategists here. In the context of quantitative easing, how important within the transmission of quantitative easing is dollar weakness? Do we just assume we need dollar weakness to have a successful quantitative easing, a successful reflation?
Well, remember that success requires that the money multiplier generates. If you're going to merely add X $100 billion to excess reserves and they just sit there on the asset side of the commercial bank's balance sheet, not being relent, you've merely gone through a very interesting bookkeeping calculation, but has no, I mean zero, economic effect. You've got to break that psychology which prevents the current $1 trillion from being invested. In other words, you need commercial bank A to lend to steel company B the reserves it is holding there. It's the only way you get the system moving. That is not happening. And so that implicit in this increased quantitative ease is basically the implication that somehow it's going to get the money multiplier moving. Now, it is conceivable that it might, but nobody who is involved in this, and I mean, clearly, Federal Reserve understands this issue fully, and they recognize the risks and the non-risks and all of the various other things. It is very difficult, however, to think through the scenario by which you induce the individual commercial banks to lend to customers. If you don't do this, quantitative easing can't do anything to speak of. It can lower it can lower yields, it can raise asset prices up to a point, but unless it triggers the asset effect, the spillover of assets into economic activity, it's not working.
If it's just simply an animal spirit of business, can a government jumpstart that animal spirit? Can they spur nominal GDP up enough to kindle it? In your study of this, how do you get back to?
I don't think it happens that way. I think that in my experience, triggering or dissipating that malaise, if I may use the term, you got to go through a period of boredom, not sparking. You don't spark that. That's not what human psychology, being what it is, whether we like it or not, doesn't get sparked. It gets a gradual erosion of fear. And all of a sudden you start taking little baby steps, and things are moving along well, and you just pick up. That's the way markets behave. I mean, you're not going to change that unless you're going to change human nature, and I wish you good luck if you think you can.
One more question, if I may, and then we'll call it an evening. Page 111, McChesney Martin. The punch bowl removed just when the party was really warming up. Uwe part of Cantor Fitzgerald today, writing out of Hong Kong, says this will be a Fed on a booze binge. Can we use the punch bowl analogy within quantitative easing? Do we have, as someone said on my television show today, a punch bowl the size of an Olympic swimming pool?
I'm not sure I see an analogy there. I mean, you can draw all sorts of analogies, and people proliferate with these types of analogies.
It's great for media.
I can see why. It's a wonderful line, but it doesn't reflect reality. Some of them do work, but I find that the vast number of those are cliches, and they are used because you can't draw a syllogism. And I think that if the syllogism works, then you can use the cliche. But it's not. I don't think the other way around.
One final question, then, and then we'll call it a night. I could go on and on. One of the other major complaints we see is of a president administration that's devoid of business executives. The cliche is the people that have met the payroll. You were a business economist, president of the National Association for Business Economics. Do we need more business people in Washington right now, or is that a smokescreen for a set of other issues?
Yeah, I think you need more people who understand markets. Now that they don't need to be businessmen to do that. They can be, you excuse the expression, economists. But businessmen are not necessarily conceptualizers. The really good ones have intuitive fields as to how to function, and they don't intellectualize it. They've got a remarkable ability to sense how markets are functioning in their particular area. But when you put them into government, they can't generalize in any useful way. And I have not found that unless they have sort of a broad conceptual base in which they can generalize on individual events, they don't have much of a chance. But it's not the type of people, whether it's business people or not business people. I would much prefer to have, say, liberal economists running a government policy program, knowing that economics does create limits, and have somebody who doesn't understand that and is apt to do things not being aware of the types of mistakes they're making.
So you just put out a job search for Paul Krugman there, I think.
He already has one.
He already has one.
In fact, he has several.
Alan Greenspan, thank you.
But at the end of the day, it worked. And I still think, and I'm sure that Chairman Bernanke and Greenspan would agree with this, that it is not an accident that we in the United States and in other countries as well, since then, have had essentially 30 years of something pretty damn close to price stability. And the dividends of that for our people and for our societies, despite the problems of the last couple of years, I think have far outweighed the short run and substantial costs that were incurred to get from point A to point B.
In that condition, in that event, you just open up the taps because you had no notion of the shock of what the liquidity was. And as a consequence of that, you had no real judgment as to, with this historic event, what the appropriate actions were, but you knew the direction. And what we did, as you may recall, is we moved the funds rate down fairly significantly for a short period of time. And the thing that startled me was I had expected many subsequent disruptions to the financial markets because it's extremely rare to get a crisis of that type in which a speculative market, whether it's silver or whether or not it's stocks or anything else, you're looking at a situation in which you get the first shot down, you get tendencies to recover, but usually there are second and third testings of the market. And we indeed went through that. And it was touch and go with such problems as whether or not the New York Stock Exchange would shut down. I remember having conversations, I think it was with John Phelan, I think was then chairman of the New York Stock Exchange. And he was telling me we're going to have to shut down in an hour. And I said, John, don't think of shutting down. Think of how you will reopen if you shut down. And we were very fortunate because as that hour approached, from where I do not know, but a flood of investment funds moved in, it stabilized it, we got past that. And it was pretty rough for the weeks subsequently. Now, I haven't a clue to this day whether it was the injection of massive amounts of liquidity in the short run which stabilized the system, or it was utterly irrelevant. But we had never seen that type of phenomenon before, and we had no way of judging it. And we haven't had, really, with the exception of the most recent crisis, which is complex by so many other aspects, really essentially what one makes of that period. But the data show, of course, is that we had a major decline, and one could describe it as a bubble because the run-up in stock prices in the summer of that year was really quite extraordinary. But granted it was a bubble, it had no footprint on the GDP that I could find even to this day. And we ran into the same thing in the dot-com boom. And the dot-com boom had many of the characteristics of what happened in 1987. And again, you cannot tell that there was any significant financial problem. Then we ran into 2007 and 2008, and it was a wholly different ballgame.
What we found out, of course, was that the crisis that began in 2007 and hit its peak in the fall of 2008 was an extraordinarily complicated phenomenon. It wasn't simple bank runs or a stock market crash. It was an interaction of so many different complex and global aspects of the financial system. I recently testified before the Financial Crisis Inquiry Commission, which is charged with explaining the crisis, and I wish them great luck. But my testimony, which is available, sort of summarizes what I think are some of the key features, including leverage, which you talked about in the last session, problems with risk management, gaps in the regulatory system and the shadow banking system, and many other complex and interacting features that led to the crisis. But I think one example, which I found very instructive, relates to work by Gary Gorton, who looked at the interesting analogies between the shadow banking system and the classic or the traditional banking system. Gary pointed out that the traditional commercial banking system didn't have enough insured or safe liabilities to satisfy the huge demand for liquid assets. This was a point also that Marvin Goodfriend was making earlier. And so the shadow banking system arose, and what it did was, essentially, it created, on the one hand, all of these so-called AAA assets, and Anil's picture of how the alchemy of financial engineering transformed sort of mediocre underlying assets into AAA, the shadow banking system held those as assets and then created short-term liquid liabilities with which to finance those assets. And so it was very much the same structure as a bank, except it didn't have the protections, the guarantees, and the oversights that a bank has. As Gary explains it in some nice papers, and others have worked on this as well, the essence of a banking system when you have liquid assets is that you believe that the assets on the other side are essentially perfectly safe or guaranteed in some way. And once that belief is shattered, then your best response is to pull out to pull out your short-term liquidity as quickly as possible. That's essentially what happened in the fall of 2007 when a couple of hedge funds said they couldn't value some underlying collateral, and problems with subprime mortgages were becoming evident, and the decline in house prices was putting pressure on those mortgages. It became increasingly evident that the so-called AAA securities were not AAA, that there were going to be losses, and that, of course, as in any classic bank run situation, generated a broad panic in the shadow banking system and in the money markets. So it was interesting in that this was in some ways, an absolutely clear, predictable, and understandable phenomenon in the sense that it looked very much like a banking crisis of the 1830s, and yet because it was in such a complex and novel institutional context, one that had outgrown the underlying regulatory structure, our ability to detect it and to anticipate it and protect against it, well, perhaps someone more omniscient than me could have done it, but it was difficult for us to do, particularly given the sort of silo aspects of our regulatory system where individual regulators had different responsibilities. So the crisis, as you know, began in 2007 and intensified with the Bear Stearns phenomenon, which again was very much tied into a run, in that case in the repo market. After Bear Stearns, there was a period of some calm, but then we saw Fannie and Freddie, and of course things picked up with Lehman Brothers and AIG, et cetera, in the fall. Now, people who've written about the crisis have focused very much on the individual institutions and the attempts of the Federal Reserve and the Treasury and others to protect or rescue them. Let me just say, first of all, that based on historical experience and also just knowledge of markets and theory, I was persuaded that given where we were and given the global nature of the crisis that we had to do all we could to avoid the collapse of these major global financial institutions. Not, again, of course, as you all understand, not because of any desire to protect the creditors or equity holders of those firms, but because, as we found out with Lehman Brothers, that the collapse of one of these firms could have enormous effects on the broad financial system. Now, the reason that in some sense, that those episodes were so dramatic was in a sense that we as a country were completely unprepared to deal with that kind of phenomenon. Given our congressional presidential system, unlike not a parliamentary system where the government can act relatively quickly, we didn't have mechanisms for quick response from the government. We didn't have tools to safely resolve firms that were not banks. You know, the FDIC has a set of tools for resolving banks. We didn't have any analogous tools to resolve a large insurance company or a large investment bank. And so a lot of those episodes were ad hoc. We were using the tools that we could put together, cobble together. I think if anything good has come out of this, I hope it is that we will, in the future, both create a much stronger ex-ante supervisory regime over systemically critical firms, which is what the Dodd-Frank bill attempts to do, so that it's much less likely that they will come to this kind of brink situation, and that, should that happen, that we have a resolution regime and a well-established principles for resolving these firms in a way that does minimal damage to the broader system. So that part of the whole episode, the response to individual firms, which was the thing that cost us the most sleepless nights, was really an attempt to deal with what was really a very inadequate institutional structure and political structure for dealing with this particular kind of problem. Now, beyond those, though, I think beyond these dramatic events, I think that history and theory provided some very useful tools for addressing what happened in the crisis. And I'll just talk briefly about two broad sets. First of all, the Federal Reserve was set up to ensure financial stability. We know from Bagehot, we know from Thornton how central banks are supposed to respond in a period of panic. In particular, we're supposed to lend freely against good collateral to provide liquidity. And that's precisely what we did. I mean, I thought of this whole thing as being that Bagehot would have been happy with what we did. We set up all kinds of new mechanisms, recognizing that commercial banks were not the only run-prone institution in the current environment. We had to worry about money market mutual funds and the repo market and many others. And we were creative, and we worked with the Treasury and did what we could to set up provision of liquidity to those troubled firms and markets. And I think ultimately that proved successful. We ended essentially all our major interventions, our major liquidity programs at the beginning of this year. So that part, I really think of it as a classic central bank lender of last resort response, again, adapted for the complexity of the financial system. I would add, in addition to that we also made good use of our supervisory function throughout the entire episode, as was the case in the crises faced by my colleagues here. An example I would give would be the stress tests that we led in the spring of '09 that were very successful in providing information to investors and to the public about the state of the banks, and which was essential for them to be able to raise capital and strengthen themselves in the subsequent months. So that's the liquidity, financial stability half. The other part of policy was monetary policy. And there again, I think that our approach was there was nothing unusual about it in the sense that we were trying to respond to a collapsing demand and a contracting economy. We cut rates very quickly. Of course, we ran into the zero bound, which we had some discussion with in 2003. We ran into the zero bound quite literally in December of 2008 when we brought the federal funds rate down to the range of 0 to 25 basis points. And from there on, we had to change our measures, our methods of operation. Again, Marvin talked about this very well. I think the point I'd like to leave with you is that there's a sense out there that, quote, quantitative easing or asset purchases is some completely foreign, new, unstrange kind of thing, and we have no idea what the hell's going to happen, and it's just an unanticipated, unpredictable policy. Quite the contrary, this is just monetary policy. Monetary policy involves the swapping of assets, essentially, the acquisition of treasuries and swapping those for other kinds of assets. And similarly, the way federal funds rate management essentially is aimed at reducing medium and longer term interest rates and raising asset prices, quantitative easing has exactly the same objectives. And so it'll work or not work in much the same way that monetary policy, ordinary, more conventional, familiar monetary policy works. So there is not really, in my mind, as much of a discontinuity as people think. Monetary policy is monetary policy. It's just that the specific tools that are used to create more easier, more supportive financial conditions are somewhat different. But we took action in this line, as you know, earlier this week. The motivation is precisely the one that that we all have learned is the appropriate motivation, which is that we have inflation, we see disinflation, we see inflation that is low, below the target or below the preferred range of most of members of the FOMC. And we see an economy which is, has a very high level of underutilization of resources and a relatively slow growth rate. So, the standard considerations suggest that we should be using expansionary monetary policy, and that was the purpose of the action. Again, nothing extraordinary, just a different set of tools to achieve essentially the same kind of results. So I'll stop there. I have rejected any notion that we are going to try to raise inflation to a supernormal level in order to have effects on the economy. I think that our credibility must be maintained. I think it's critical for us to maintain inflation at an appropriate level, and we've provided through our projections a pretty clear sense of what the committee thinks is the appropriate long-run level for inflation. Now that being said, we've had, at least according to many measures, we've had a fairly significant disinflation since the peak of the business cycle in December of 2007. That's at least indicative of a world in which monetary policy is insufficiently stimulative. We can all debate about how much the monetary policy can do for the real side of the economy. Personally, I think it can be helpful, but nominal quantities are the Federal Reserve's responsibility. And if inflation is declining and continuing to decline, I think at a minimum we should not be satisfied with a situation where we have both a large amount of slack on the employment side and inflation which is below our generally agreed on preferred level and seems to be declining over time. So in that respect, I think that's a signal that more should be done, as I said in my speech in Boston. And that was the motivation for the action taken earlier this week. But I couldn't agree with you more. Again, we're not in the business of trying to create inflation. Our purpose is to provide some additional stimulus to help the economy recover and to avoid potentially additional disinflation, which I think we all agree would also be a worrisome outcome. But we are equally committed to both sides of our mandate.
The issue is basically that the Federal Reserve tended to react far more significantly to weakness in the economy than the upside, that there was an asymmetry of response to the economic events. And if you look at the data, there is no question that monetary policy eases far more rapidly than it tightens. But that has got nothing to do with the issue of asset prices or the issue of setting up a put. That's what the economy is doing. Because the National Bureau, for example, say over the past 50 years, indicates that our economy was in recession 14% of the time. And if you look at the unemployment rate, you will find that it rises very sharply and then eases down very generally. So what is being observed and what is being interpreted, as the Greenspan put, and I appreciate the notion that this is a great invention of mine, is essentially the way one would expect a central bank to respond to the economy. Now, I don't deny that because we endeavored increasingly over time to try to be anticipatory and preemptive as best we could on the basis of the knowledge we had. And obviously, if you begin to see very major changes in equity values in the economy, and you know what the wealth effect concepts are, and you know the impact of changes in equity prices on, for example, the market value of financial intermediaries, because clearly the extent to which you have problems in a financial intermediary to a large extent depends on the market value of the equity of the intermediary, because it is that market value which is the support for the liabilities of the institution. And essentially, a big infusion of unrealized capital gains in a financial institution enables it to very substantially improve on its ability to lend. And indeed, the credit rating agencies, hopefully better than they've been done, obviously rise for the senior debt of a financial institution if the market value of equity expands. The converse of that, when you're seeing a sharp decline, is that we know that there are certain effects that are going to occur in the economy, and we tend to respond to them. But we're responding to the economy, not to the markets, not to interest rates. We're responding essentially to what our job is, namely to stabilize the system. Now, if in effect, the Greenspan put is a notion which says you're stabilizing the system, I say, well, I hope so. That's indeed what we're here for, to celebrate the origination of the Federal Reserve System, which was created largely because of the extraordinary panic in 1907, which accumulated a long series of such panics. And monetary policy, if it's a functioning issue at all, has got to largely be an issue of trying to stabilize the economy, so that I don't really have an understanding of why that has become a pejorative term. I mean, I listen to it, I know what they're saying, and I'm saying, but if I understand you correctly, what we're doing is what we should be doing. And in that sense, it's an issue of success, not failure.
But which has to be, in a sense.
If I may say, I don't think that's what happens. In fact, going back to, say, 1994, what we observed, and my good friend's sort of piece had many quotes directly out of the FOMC hearings. At that time, we were talking about bubbles in the financial markets and in the stock market, and our general view was basically that there was a speculative froth going on, and we indeed were tightening. And that 300 basis point rise in 1994 was not directly related to stock market speculation, but we were aware that there was an incipient bubble in the market emerging, and it appears directly in the FOMC discussions at the time. What happened, in fact, is that we raised the funds rate, that is pushing against the issue, by 300 basis points, and did stop the stock market cold for a year. As soon as we stopped raising rates, the market took off again. and we went through the same process later in the decade. I concluded from that while we may have thought that we were trying to lean against the wind and diffuse it, we in fact did precisely the opposite. Because what the market, this is an obvious interpretation, the market was probably saying to itself, wow, the stock prices went through a 300 basis point crunch and nothing happened. Therefore, we have underestimated the equilibrium level of the Dow Jones Industrial Average, and it took off from there. So this presumption that you can incrementally diffuse these bubbles is working very fine in an econometric model in which we define the structure of the model in such a way as to get that conclusion. All it tells me is that we're missing a variable in our models which doesn't capture this feedback effect, which I suspect is very real, and in a sense, this notion that you can incrementally impact on the economy or on the markets is really something which exists only within our models. It doesn't exist in the real world, and there's another reason, incidentally. You know, if monetary policy has long invariable lags, how do you get the feedback effect in time to know whether or not the incremental actions you're taking are actually working? I mean, if we're sitting there and we're saying, well, we're going to increment the funds rate, the problem is the delayed effect is so long and so variable, we have no way of knowing how to increment. So this notion that is fairly general, I find very puzzling because I don't think the evidence at all supports it. What, in retrospect, would have been required to prevent the crisis of the post-Lehman Brothers default crisis? And the obvious question is that Lehman Brothers, I think, went to the wall with 3% tangible capital. What if it happened, what if it had 20% capital? Or 50% capital, like they used to have prior to the Civil War? The answer essentially has got to be, at some point, if there is adequate capital, and the word adequate is a crucial word here, by definition, you do not have defaults of senior debt. And you do not have contagion, with the exclusion of the wealth effect, in a system in which there are no defaults. And as far as I'm concerned, much of what we have run into here is a misjudgment as to what the tail risk of the probability distributions were. And in effect, as I recall, and I'm sure Ben has been far more involved in this than I, there has been a very interesting discussion going on prior to the Lehman event, or even prior to the Bear Stearns event, that the tail risk was not a normal distribution, that it was a very non-linear distribution which had a fat tail, but which we had never actually observed because we never got to the point that we got to in 2008. And in the event, if you look through the actual tracing and make it retrospectively, putting it in where the distribution, risk distributions would appear, that the tail was not fat, it was obese. And the problem essentially is that we had an extraordinary implosion as a consequence of that. And I think the lessons that at least I've learned, I don't know to what extent we're going to get it in the regulatory system, but I think that the financial intermediary system in the United States, and I suspect elsewhere as well, was implicitly subsidized by the taxpayers. I know in our case, because we had less capital through that period than in retrospect we should have. And the question is that therefore the financial system was subsidized by the taxpayer. The bill didn't come due until after September the 15th, 2008. That's just because the billing relationships took a long time. But it's all capital that I see as the problem, And I'm not saying there are lots, I think there was rampant fraud in a lot of what was going on in these markets. But my general judgment is that there are two fundamental reforms that we need is to get adequate capital and two, to get far higher levels of enforcement of fraud statutes. Existing ones, I'm not even talking about new. Things were being done which were certainly illegal and clearly criminal in certain cases, which, I mean, fraud is a fact. Fraud creates very considerable instability in competitive markets. If you cannot trust your counterparties, it won't work. And indeed, we saw that it didn't.
Just one comment that all of these points lead to, which is that there's a difference between an equity bubble and a credit bubble. An equity bubble, particularly if it's an unlevered bubble, is a loss of wealth, and unless it's a huge bubble, like perhaps the Japanese case, it's going to be absorbable by the system, as we saw in '87 and the relatively mild recession in 2001. If it's a credit bubble, which is highly levered and leads to loss of capital and loss of capacity to intermediate new credit, then the damage is much, much greater. Now, what that suggests is that all of this talk about the Greenspan put, or the Greenspan-Bernanke put, or whatever, which thinks implicitly about the stock market, is more or less beside the point. I mean, the real issue is what can we do to just keep our financial intermediation system strong. And the position I've maintained throughout is that the first line of defense, at least, should be capital, supervision, liquidity, and other restrictions to make the intermediation system as strong as possible. So I agree with Chairman Greenspan about that.
One of the issues that Marvin Goodfriend brought up was the difficulty for the Fed in occasionally being the only game in town, having the flexibility, having the capacity to undertake certain actions which should, in theory, be the realm of other agencies of the government. The example he brought up was the Mexican loan. One could think of, for example, today, where a number of economists have argued that fiscal policy might be more effective at this point than monetary policy, but monetary policy might be the only game in town because of the state of play in Washington. What's your sense about how do you choose, difficult choice between being a team player, stepping up to the plate, but at the same time risking sort of being part of the political process and perhaps losing a certain amount of independence? I think Marvin had a case study there where he described some of the content of the discussion. How has that thinking evolved over time? Maybe first with Chairman Greenspan and then.
Well, remember that the Federal Reserve is the fiscal agent for the United States Treasury, that there is really only one monetary authority in the United States. We unfortunately, in our bookkeeping back in 1968, when we decided to create the unified budget, left the Fed outside of that, and it's caused all sorts of distortions, and it's created an illusion that the sovereign credits that are employed by the Federal Reserve, the central bank, are different from those of the Treasury. They are not. There's only one sovereign credit that's involved in this whole process. And so I think that you have no choice but to coordinate with Treasury, and the question there raises a major problem of Federal Reserve independence. And that is one of the most difficult problems, I think, that the institution has to fulfill its role as a partner in the maintenance and care of the sovereign credit of the country and the independence of the central bank from government. Those are not obviously reconcilable views, and there's a considerable tension that always exists, that always will exist, and I don't know how you make any difficulty. I mean, I, for example, think that I've argued that 13.3, everyone knows what 13.3 is now, I hope, had to be used when we had what I think was the greatest global financial crisis ever. Not the greatest economic crisis, that was the Great Depression. But I don't recall the history indicating the extent to which the shutdown occurred in financial markets, in the commercial paper market, in the RP market, in money market mutual funds, trade credits. Those things never shut down previously. I mean, the call money market, for example, was open during the Great Depression. The rates went to 20%, but it never shut down. It is true that there was a major contraction of credit availability because of the failed banks in the 30s, but the institutions stayed open. In 1907, there was one day in which the call money market shut down. And I think the bid rate went up to, I think, 168% or something like that. But I don't recall, and I've reached back into history as best I can, but I've never yet found an instance, anything remotely close to what the Federal Reserve had to deal with here. And I think that 13.3 is clearly useful, and indeed it was the thing that we actually amended as late as 1994. I mean, it wasn't as though this is some obscure depression vehicle which we'd never thought of and we pulled out. The interesting question here, however, is that if the Fed is going to put things on its balance sheet, I think that it's incumbent upon the United States Treasury Department to take the Fed out. Those are not monetary assets. 13.3 is can be and has turned out to be a non-monetary vehicle, and it's properly used as essentially a fiscal agent. But the Fed should not be asked to keep that stuff on its balance sheet, and in so doing, you create really serious political effects, which I think are self-evident at this stage, and I think are unnecessary. The reason, of course, goes all the way back to the 1960 Unified Budget Procedure. For the Treasury to do that, they would have had to have gotten appropriated funds where the same credits are employed by the Federal Reserve without such.
I think there's a lot of intellectual confusion about what Federal Reserve independence means and what it's for, and also about cooperation and what it's for. The clearest case for independence is making monetary policy, because we want to avoid short-term political interference in monetary policy decisions, and there's a good case for why a longer-term perspective makes sense. And throughout the crisis, the Federal Reserve has been completely and entirely independent in all of its monetary policy decisions. There's been no issue there whatsoever. A second area is supervision. There are good reasons for supervisors to be independent so that they can carry out closing a bank, for example, without interference from Congress. But that being said, the independence that a supervisor has is different from that kind that a monetary policy maker has. And when the Fed is operating in its role as a supervisor, its relationship to Congress is somewhat different. For example, we are carrying out the statutory laws and the framework that the Congress has put down. Now, in the case of a financial crisis, obviously we don't want to compromise our independence, but I think there is both plenty of precedent and plenty of clarity that cooperation in trying to arrest the financial crisis is perfectly appropriate. And in fact, you can see that in things like the systemic risk exception in the fiducia law, which requires a collaborative decision by the Fed, the Treasury, et cetera, and the FDIC that a systemic crisis exists. The Financial Stability Oversight Council just passed is also a collaborative institution. So a collaboration in itself to arrest a financial crisis, I think, is not in any way inconsistent with monetary policy independence, which is a different function. Now, that said, in carrying out financial stability operations, there are different roles. And the Federal Reserve made every effort, and I think we were pretty successful in restricting our role throughout the process to liquidity provision. That is, we're required by law to lend against good collateral, or technically to be secured to the satisfaction of the president of the Reserve Bank making the loan. And we've had no losses, and we've been repaid, and most of our programs are being shut down. So I would argue that, as best as we could, and I think pretty effectively, we collaborated with the Treasury on managing the crisis, but we still tried to respect each other's roles, where the Treasury injected capital and took losses, and the Federal Reserve, wherever possible, lent against good collateral. The reason that we couldn't save Lehman, which was before the Treasury was authorized to put capital into companies, was that given that the company was insolvent, there was no way that the Fed, using its strictly liquidity providing authorities, could avoid that. Later, of course, that would have been a different story. So even as we collaborated, we tried to make sure as best we could that we were each using our own separate authorities, and there was an agreement between us and the Treasury which tried to lay out, it was sort of a new accord, I guess you might call it, but at least tried to lay out clearly that credit risk is the Treasury's responsibility, liquidity provision is the Federal Reserve's responsibility.
Deflation in 2002, 2003 was an example of this, and I would guess by extension, and I'm putting words in his mouth, he would argue that the deflation scare of 2010 might fall in the same bucket. Is he being unfair?
You asking me?
Well, let's.
I think, as I recall, Alan is a very great supporter of Milton Friedman, and let me just argue, for example, with respect to the 202-203 experience, that I wrote a rather extensive analysis of that period for a Brookings paper, which published in June of this year, in which I think the evidence that the bubble, in quotes, was a consequence of the endeavor of the Fed to move rates down when we were confronted with a fall in inflation rate in that period. My judgment is that at that point, and I think Ben Bernanke remembers it, I'm sure, because we both sat and worried about it, but it was clear that the probability of getting deflation at that time was less than 50-50. But had it occurred, the impact would have been much too difficult to deal with. And the result is that we brought rates down, and what were the consequences? Well, first of all of the evidence that I can see says that housing prices are a function of long-term mortgage interest rates with a lag of significant number of months. There was a very important relationship between the federal funds rate and long-term rates, and therefore housing prices in earlier years. But with the emergence of a globally arbitraged bond market, the 10-year note in the United States became a function of what was going on in the global markets and essentially detached from the federal funds rate. Prior to then, that the correlation between the federal funds rate and the long-term rates, for example, the 10-year Treasury note, was very high. And when you moved the federal funds rate, you would get a movement in the 10-year note. Effectively, it was saying that the term structure was stable. And the Federal Reserve staff was very much aware of the fact that we were moving incremental estimates of the term structure, but the notion that it would essentially collapse as it did in the period following 2001, when we got this tremendous flood, as Ben pointed out, of savings moving into the global economies, the consequence of, in my judgment, the end of the Cold War, which led to a major shift towards market economies in much of the developing world, which in turn created a huge level of income which they couldn't spend. They didn't have an infrastructure or a culture to do that, and that spewed over into the markets, and we had a major rise in ex-ante savings relative to ex-ante investment in the United States and globally. And the consequence of that is that if you look at the data subsequent to 2002, we were getting a M2 was never, I think, money supply by any measure was very stable during that period. I just find it very non-conceivable that the overnight rate in that sort of environment can capitalize 20-year to 30-year assets. It's got to have, the capitalization rate has got to be fixed at the same maturity that the life of the asset is. Now, the notion of this pumping of liquidity in is a very fine analogy, but the channels are never defined sufficiently. You can't just jump and say, it's therefore. And I find the word therefore is utterly inappropriate. And if you look at the correlations, and I suggest to those of you who are interested in refuting my argument, please go to the June publication at Brookings. It's the Brookings Panel on Economic Activity. And if the argument is wrong, I'd very much like to hear it because I'll change my point of view. But let me just say this. With respect to the period, Milton Friedman said, this is in January 2006, quote, "There is no other period of comparable length in which the Federal Reserve System has performed so well. It is more than a difference of degree, it approaches a difference of kind." Now, being that Milton Friedman was the most severe critic of the Federal Reserve up to that point, I do think that sometimes his viewpoints ought to be considered in this particular case. And I'm surprised that, I don't know whether or not you're quoting Alan correctly, frankly, but if he said that, and I don't like to quote people, especially when they're here, and in a second, but all I can say is that if that's the case, Alan, both Milton and I disagree with you.
I have great respect for Alan and particularly his magisterial work on the history of the Federal Reserve, but Chairman Greenspan reminded me of something. I think I'll be provocative because Alan Meltzer wrote an editorial recently, an op-ed, saying that Milton Friedman wouldn't approve of the Federal Reserve's behavior. I grasped the mantle of Milton Friedman. I think we are doing everything Milton Friedman would have us do. Besides the stability of the period that Chairman Greenspan just referred to, I think what Milton Friedman would say is that the Federal Reserve is responsible for the stability of nominal aggregates, including prices. And that means that, in particular with respect to inflation, that you don't want inflation to be too high, but you also don't want it to be too low. And as someone mentioned earlier, based on what we knew, given the data in 2003, the downside risk was greater than the upside risk. And we adjusted appropriately. And we did so in a way that did not lead to long-term inflation, and achieved quite a bit of stability of the monetary aggregates and of inflation. Likewise, in the more recent period, our objective has been, among other things, to try to keep inflation neither too high nor too low. If you look at what's happened to key nominal aggregates like nominal GDP growth or broad money aggregates, they're all saying that we need to do more because nominal GDP has been growing very, very slowly for the last 2-3 years. Broad money aggregates have been growing very, very slowly. So even from a strictly monetarist perspective, we need to do more. So I just disagree. We have the issue in the long term for the central bank, of course, is inflation. There are many other issues that the fiscal authorities and so on have to deal with. But as I said at the very beginning, we are committed to both parts of our mandate. We are confident we have the tools to manage our balance sheet in a way that will allow us to achieve price stability in the longer term. But what we're trying to achieve now, which is entirely consistent with monetary theory and practice, is stability of inflation and stability of monetary policy within an extraordinary circumstance, extraordinary context. But, you know, so I think we're considering both the long term and the short term.